Lots of anxiety surrounding the market today, even though we're only about 1,200 points, believe it or not, from the all-time high. The focus also going to shift to jobs report, and the question is going to be on Friday, what kind of number do we need to hear? What's the Goldilocks number that's strong enough to keep the economy going, but keeps the Fed at bay? Plus, of course, there's this yield curve, the inverted yield curve, massive decline in homeowners over at Toll Brothers. There's a lot of things that could potentially be black swans lurking about. Here to help break it all down, some potential risks to this market, Chief Market Strategist for Delancey Strategies, Jared Levy, MaxFunds.com founder and Fox News contributor, Jonas Ferris. Jonas, there's almost an endless list of things that could possibly be black swans, right? Although you're not supposed to know what a black swan is. But nevertheless, Wall Street's got a lot of things on their worry list today.
It just got a little scary today, I'm going to be perfectly honest. And it's at the top of the list is the inverted yield curve. And what that basically means is longer-term rates are lower than shorter-term rates. And that predicts recessions. Unfortunately, it predicted like 10 of the last 20. It's not always right. But it's enough right to scare investors right now. On top of, we've already had a rough year with tech stocks collapsing. Is the tariff thing lingering? I just want to say the tariff thing is not as a big deal as this interest rate thing. As you just were interviewing Peter Navarro, it's $7 billion. How could it cause a global recession if it's $7 billion in tariffs? That is a week's interest on the debt. It's nothing. It is not a huge tariff yet. Now, is there scary stuff going on today because the president's talking about being a tariff man, talking to the European automakers? We don't want to see them getting tariffs. They're not crooked dealers like the Chinese market. Right. But the interest rate situation is a big deal. I think the Fed made a mistake. The president brought this up a few weeks ago. They basically wanted to raise short-term rates too high. They should have kept the long end a little higher than short rates. It wouldn't have scared everybody like we're doing now. They could have unloaded some of their bonds and their portfolio built up, and we'd be in a better situation.
Jared, we know President Trump uses Twitter and other things as a form of not just communication, but also, to sort of beat or get people to do what he wants. In this particular case, Volkswagen just moments ago, their chief executive saying, after a meeting with the White House, that they're building an alliance with Ford Motor Company, and they probably will use some of Ford's auto plants to build cars. I mean, ultimately, I guess this is what President Trump wants to do. To Jonas's point, we don't want to hurt our friends, but it would be great if we can get more manufacturing in this country.
Yeah, I mean, if there's one thing I could say about Trump, he's a deal guy, right? Do I like his communication style? Not really. Do I think it's effective on some levels? Yeah, right? I mean, he knows how to rustle feathers, sometimes unintentionally. I do think that it's sort of smart to make lemonade out of these lemons, right? So if this is the truth, that's great. That's what you want to do. But at the same time, you've got to be careful at delivering very strong message to what I'm calling a market of caveats. Both on the bullish and the bearish side, everybody's got a caveat. The bulls are saying, yeah, we can keep going, but if this happens or that happens, like an inverted yield curve, or if the housing market slows, then all bets are off, or if inflation. The bears on the other side are saying, well, if Trump can do this, then he could, turn things around.
Jared, so how much of this, the tariff man tweet, how much of that do you think was responsible for today's sell-off?
I think that was minimal. I think what started off here, you had the 2 and 5 year, which is not a big bond, relationship to watch. But I think if you look around, the headlines that I saw flashing across the screens were bonds go inverted. All heck is breaking loose. They started calling every bond guy, talking about how this is the beginning of the end of recession, how this preceded every recession over the past 10 years. And again, statistically, you got to be careful when you start throwing out data like that.
So both of you guys agree on the inverted yield curve being the biggest driver of the market to the downside today.
It's why the market's down, but I don't believe it is a good predictor of it for a lot of reasons. One is there's a huge balance sheet on the Fed, so they're sort of manipulating the long end curve by not selling those bonds off, which would send rates higher. And then there's so much money in bond funds now, and those bond funds are very big players in kind of the lower duration part of the curve, and that's why you saw like the two. I don't want to get too complicated, but there's a lot of money going into bond funds now in the 2 to 7 year area, which is shifting the demand. It is a scary sign. Investors are prone to fear, but this is one that causes fear. It doesn't mean it definitely is going to cause a recession. In fact, the lower rates on the long end are going to help mortgages. You just saw Toll Brothers with bad numbers, partially because mortgages went up a little too high earlier this year. It was just a few weeks ago we were talking here about the rates at 3 1/4 causing 5% mortgage rates being a problem.
Other things today, Jared, the UK Parliament holding Theresa May's government and contempt. That's huge. I think that's making, obviously causing some pressure here. The action in specific sectors, particularly financials, are any of these things yellow, perhaps even red flags for you?
Again, everything's got a caveat, Charles. As I watch this market, the trader in me is obviously liking a portion of it, but technically the action I'm seeing does not look good. We saw that traditional sort of cycle out of tech. In October, everybody started to get scared, sell off those high beta,
right.
Sort of high multiple tech companies, move into the safer stuff. I think that's going to continue, but there's nothing. I should say there's nothing. There are not many things that are standing out to me that are like, oh my gosh, this is a nightmare and you better run. I don't like what I'm seeing in the housing market.
Okay, a whole bunch of things.
Yeah, a whole bunch of little things.